Good morning, everyone. I'm not prone to stage fright, but I saw the attendee list, and this is quite an impressive and formidable group, so I will try my best. Today, I have the pleasure of interviewing Superintendent Harris, who is head of the New York State Department of Financial Services. So without further ado, let me just kick off with this question, Superintendent. For those of us from outside of New York State and around the world who are not as familiar with the DFS, can you give us how your organization fits into the financial ecosystem?
Yeah, absolutely. Well, good morning, everyone. Thanks for having me. DFS, as you noted, is the financial regulator for New York State, for the financial capital. We oversee a couple thousand state-chartered banks and credit unions, including 15 GSIBs, about 120 foreign institutions, insurance across health, life, and property and casualty. For a long time, we've been the only prudential regulator of crypto, state or federal, in the US. Thankfully, that is changing. We oversee money transmission, student lending, mortgage servicing, pharmacy benefit manager, so you name it. We oversee it to the tune of almost $10 trillion of assets in our regulated entities. So quite a broad purview.
So what is the path that brought you to your current role as the superintendent of that massive organization?
I ask myself that all the time, especially when there's a banking crisis. I'm like, how did I get here? Now we've just had my 4-year anniversary at the department. So I started my career at Sullivan & Cromwell in New York doing a lot of financial regulatory work, some Latin American M&A, derivatives work, other things, before going to the Treasury Department in the Obama administration as a senior advisor to Sarah Bloom Raskin, who was the deputy secretary, doing Dodd-Frank implementation, GSE reform, cybersecurity, CFIUS work, all kinds of fun things, before they brought me over to the White House as a special assistant to President Obama to run the financial services portfolio there. It was there that I sort of added to my remit a lot of work around fintech, stood up an administration-wide task force on fintech and distributed ledger technology. And then when that administration ended, I was so taken with the fintech world, I thought I should put my money where my mouth is and go to San Francisco and start a fintech company. I thought, I'm already pretty broke from government work, so if it's a complete disaster, it'll be fine. Thankfully, it was not a complete disaster. We built a very strong company, took it public a couple years later, at which point I decided I am really an East Coast girl, no offense to the Californians. So spent some time teaching grad school at the University of Michigan, sitting on a number of boards, advising venture capitalists, swearing I would never come back to public service, and yet here we are. I met Governor Hochul and was really just taken with the opportunity to prove out a thesis that you can protect consumers and markets and be good for business all at the same time. And there was just no better place to prove that thesis than the financial capital, and here we are.
And this time is a really fast-changing environment.
Yes.
So how would you describe your approach to regulation, given you have to balance innovation versus consumer protection at the same time?
Yeah, I think so much of it just comes and is informed from my background, having been sort of in big law and representing large financial institutions, having started a small company and grown that, and seeing what it's like to manage the compliance of a startup. So for me, like I said, I sort of grew up as a professional seeing people think you could protect consumers or you could be good for business, but you can't do both. And it's just a premise that I've always fundamentally rejected. So for us, we begin and end with the data. We think quite a lot about stakeholder management, knowing that not every decision we make is going to be popular with everybody, but how do we make decisions transparently based on data, engaging all of our stakeholders, exposing our work to comment from the public quite often, even when we're not legally required to do so, so that when we make decisions, write a new regulation, issue a piece of guidance, take a regulatory action, there is that transparency around how we got to the decision we made, either for the regulated entity that's particularly affected or for the marketplace generally.
So having had 4 years being at the helm and seeing the data, what in your view is the biggest challenge facing banks, asset managers, insurance companies?
Yeah, I mean, I think there are many, many challenges. It's hard, as this group knows, to identify just one. Cybersecurity is always top of the list. We actually amended DFS's cybersecurity regulation in 2023 to account for new things like the affordability now of multi-factor authentication, whereas when the reg was originally drafted in 2017, that was maybe harder for our small institutions to implement. Now it's sort of table stakes. We amended that reg to take more account of governance requirements that we thought were appropriate. And then we followed that on with guidance around AI and cybersecurity. So cyber is always top of mind. Obviously, geopolitical risk generally, I think, is a really interesting space for our institutions to be navigating, especially our global institutions where they might get competing objectives and requirements from different jurisdictions. Climate is something we think about quite a lot, especially for our P&C insurers. What does that mean for housing, mortgage affordability, auto insurance affordability? I was with the rest of the cabinet for the state a couple weeks ago, and all of my colleagues in the cabinet took the opportunity to come and talk to me about their auto insurance rates. It was really fun. So climate is something we think about quite a lot. And of course, AI, right? You can't go anywhere these days and have discussions like this without talking about AI and both the risks and opportunities it presents.
Right. Well, more on that later. Yeah. But as an agency, does the DFS use new technologies to help you enforce and regulate?
Yeah, we certainly do. I mean, when I came in, there hadn't been a lot of investment either in human capital or technology. So we were thankfully able to get the agency fully funded for the first time in its history when I came in. We've now hired or promoted over 1,200 people in 4 years, which is a huge accomplishment, especially I think in an era where we're only seeing sort of government cut back on staff. So that's been really wonderful. And then we're in the midst of a technology transformation, which I love to brag about this because I think unlike what we often see in government, we are on budget and ahead of schedule on our technology transformation. So we've created a portal called DFS Connect, which allows consumers in all of our regulated entities to use a single portal to engage with the department, whether it's around enforcement, examination, complaints, and then provides the proper access rights, identification, other things on the back end so that the entire history of our engagement with a consumer or a regulated entity gets organized appropriately for the staff to access. And we're also doing lots of fun pilots with AI, from reviewing regulatory submissions for completeness to a chatbot to a really cool initiative we have with SUNY Albany around using weather data, mortgage data, and insurance data to draw supervisory insights about what climate change is going to mean for mortgage and insurance availability. So very tech forward at the department.
And everything you said brings us all back to consumer protection. I think that is arguably your principal service that you're rendering. So how can FIs work more closely with the regulators to achieve better consumer protection?
Yeah, well, one of the things I'm very, very proud of is in my time at the department, we have returned over $725 million back to New Yorkers in the form of restitution. So that's not penalties. That's just money back when people call with a complaint, a bank fee that shouldn't have been charged, an insurance claim that wasn't paid and should have been. $725 million in 4 years. I'm just incredibly proud of the team for that. What I always say to regulated entities is that if we read about it before we hear about it directly from you, you're already starting in a bad place. So we really encourage people, right? Regulators, I always say we are a risk-averse people by nature. So we like to have that engagement, that proactive discussion with our regulated entities, even if it's going to be bad news, so that we can problem solve accordingly.
Okay, so here's the question I think everyone would like to hear about. Certainly I do. Many of our FIs and many of your supervised entities are trying to develop AI-assisted, AI-enabled technology. Mm-hmm. So how should we proceed with caution? What are the things that we should be mindful of so that we don't run into regulatory scrutiny and findings?
Yeah, I think the companies we've seen have the most success with this will sort of come in and walk us through everything that they're doing, whether they've bought it, whether they're building it. We spend a lot of time with some of our more forward-leaning entities really going through the business plan. What do the next 5 years look like? How are you rolling this out? What are the use cases? Who are the staff you have? What are the governance protocols you've put in place? And I've really been impressed, again, with some of our more proactive entities, just the thoughtfulness with which they've approached implementing AI throughout their business. But I think that sort of general maxim of come in early, be proactive, sort of talk to your friendly neighborhood regulator about your business plans holds true in the AI space. Certainly, I think everybody's trying to navigate where this is going together. So I think that piece is really important. We've started to put out guidance on various types of AI and use cases, so it's obviously too big a topic to say, here's how we're going to regulate AI. It's even too big, for instance, to say, here's how we think about AI and insurance. So we've really been trying to break it down into bite-sized pieces. So we issued a piece of guidance last year about AI and insurance pricing and underwriting, right? Took this sort of narrow slice and said, look, the standard principles of not having unfair discrimination in insurance still apply with AI, right? The new technology does not mean that these standard principles, these regulatory principles no longer apply. They certainly do. We laid out some governance requirements. We required testing of the algorithm. So then, of course, we had a bunch of companies come in and go, how can we possibly test the algorithm, right? It's a black box. We don't know. And because I had started an insurtech company that used AI, I was like, not only is it possible, but I have done it, right? So you all can also do it. And we then laid out some of the accepted testing methodologies in that guidance. We said, for instance, third-party vendor management principles still apply. It's not going to be sufficient if you come to us and say, well, it's not our algorithm, so we're not responsible for it, right? This idea of third-party vendor management is standard in financial services regulation. And so I think as we think about AI or any new technology, we try to take some of those existing principles and figure out where they still are applicable, where they still make sense, and then layer on top of that, where necessary, additional guidelines or requirements that are purpose fit for the type of technology we're seeing. We also did guidance on cybersecurity and AI, and in that piece of guidance really did a lot of work to highlight not only the risks, right, how the threat vectors are increased by AI, but encouraged our regulated entities to use AI as part of their defense mechanisms, right? That there's real opportunity there to deploy AI in terms of securing your perimeter. And so I think we always do try to be balanced in thinking not only about the risk, but the benefits for any new innovation.
Right. And the other big new innovation is digital assets. Mm-hmm. And it looks like that's here to stay, yes. At least in the current climate. Mm-hmm. So how do you keep up and keep pace with something as complex as digital assets and the intersection with banking without stifling growth?
Yeah, so we've been regulating digital assets at DFS since 2015 when the BIT license was invented. If you want to do virtual currency business activity in New York State, you have to be licensed by DFS, either through our BIT license or our limited purpose trust charter. It is a very rigorous application, I think, as evidenced by the fact that we did not approve FTX or Voyager or Celsius. We had not approved and have not approved any algorithmic stablecoins. In addition to the reg that lays out the licensing and the supervision requirements, every licensee then has a bespoke supervisory agreement that lays out our governance and regulatory expectations for them. And then they're subject to full scope examination and supervision. So much like we supervise our banks and insurance companies, we have a great team of examiners that go in on a regular cadence, examine against all our plethora of regulatory requirements for them. They're subject to the same BSA, AML requirements as our banks. They're subject to the same cybersecurity requirements as any of our institutions are. And then we did 9 pieces of guidance in the last 4 years for the virtual currency space, including around customer service requirements, including requirements for the use of blockchain analytics. We did stablecoin guidance now 2 years ago. That really is the basis for then what ultimately became the Genius Act that was recently passed and signed in DC. So it requires one-to-one backing with cash and cash equivalents, a T+2 redemption time, right? Public attestations of the reserve mix. So we were very proud to see that set of requirements then become a large part of what is now the Genius Act. So we've gotten pretty good at this, I will say. We've even brought a number of enforcement actions in the space. It is the last resort, but when we have real violations, we have to do that. We brought an action against Gemini that resulted in us getting over $2 billion in virtual currency back to consumers around the country. I love to tell a story. I got a nice email from a gentleman in Ohio. Said, thanks for getting me my Bitcoin back. And it had appreciated quite a bit in the time between when he lost access to his Bitcoin and we were able to return it to him. And he said, I'm going to come and spend it in New York. And not being one to miss an opportunity to manage up to my boss, the governor, I sent it to her, and I was like, DFS does tourism too, bringing Ohioans to New York to spend their money. So the team has just done wonderful work in this space. We now have a team of 60 professionals. I think it's the largest virtual currency regulatory unit anywhere in the world. So really, really proud of the work they've done.
Well, so inherent in that is knowledge of the space.
Yes.
And so you have to find examiners who have the knowledge and experience to perform the examinations.
Yeah, I mean, we have folks from international regulators, we have folks from the Fed, we have financial crimes experts, we have some real crypto bros on the team. The first time I made that comment, one of them sent me a note and he was like, that's me. And I was like, it is you. Right, but we've got some real crypto natives, so it's a diverse team, but that's, I think, what you need to have the expertise and the human capital to keep pace.
Right. Okay, you had mentioned cybersecurity. That's always top of mind for consumer protection. So what standards or expectations should firms be preparing for over the next few years? Because, the hackers are getting much more sophisticated.
Yeah.
They are also using AI.
Yeah, exactly. So the amended cybersecurity regulation, which we affectionately refer to as Part 500, amended in 2023, as I noted, is quite tailored because we regulate everything from GSIBs on the one hand to very small insurance brokerages on the other. And so we had to be able to craft a reg that could fit those both ends of the spectrum and everything in between. And so we redid the tailoring requirements based on size and complexity of organizations. Originally, MFA was not a requirement. Multi-factor authentication was not a requirement across the board when the reg was originally done in 2017. Fast forward to 2023, right? MFA is basically free. It's easier to implement now than it was. So we said, okay, now we're requiring everybody to implement MFA. There's obviously reporting requirements for when there is an incident. We expect companies to report to us within a specified time frame. So I think a lot of what the industry has become accustomed to, but it's important that we were keeping that reg up to date. As I said, we issued the guidance on AI and cybersecurity to add a little bit of color to what those requirements mean in light of AI. And I think the other thing, right, for me, it's not enough just to have a good rule on the books. It's got to be implemented well by the regulator, and you need your regulated universe to understand it, right, if they're going to implement it well. So we really took a lot of time to think about the implementation timeline, when certain requirements were going to become effective, so it didn't just land with a big thud on industry. That was really important. And then we did webinars and town halls with several thousand participants in industry to make sure everybody understood what the requirements are, because I think this is certainly an area where everybody has very common interest in making sure that the financial system is secure.
Right. And even though we all have common interests, I think DFS is the first regulator to mandate multi-factor authentication in systems that are essential. Yeah. I don't think other regulators around the world have that kind of a mandate. So is there any effort for DFS to align with other jurisdictions, regulators, because so many of our banks operate in so many jurisdictions.
Yeah.
And we need to be able to harmonize the various countries' regulations.
Yeah, this is always a fun challenge for us, right? We want to be harmonized, recognizing the complexity of compliance across many jurisdictions. That said, right, this is the financial capital, and so we feel strongly about if others are lagging, it's our responsibility to take a leadership role and then hopefully bring others along with us. Interestingly, with things like cyber, folks will say to us, look, DFS maybe has more stringent requirements than everybody else, but you don't have a cybersecurity program for New York, right, and a different one for St. Louis or London. So what it causes the industry to do is level up to the highest place. Mm-hmm. And so that's a good thing for everybody. There are other instances in which we do spend quite a lot of time harmonizing with international regulators, state regulators, federal regulators, and not just on the rules on the books, but we recently launched the Transatlantic Regulatory Exchange with the Bank of England, where we traded senior staff on a secondment program for emerging payments and virtual currency work. And I think in addition to making sure requirements are well harmonized, right, just taking those opportunities for our staffs to benefit from time at different regulatory institutions helps with harmonization, right, with understanding how other jurisdictions operate, and ultimately is a benefit to our regulated entities.
Is that a regularly scheduled powwow you have with other regulators?
Well, there's not a day that goes by that I'm not talking with many other regulators, state, federal, international. The Transatlantic Regulatory Exchange was something we launched just last year. It was a pet project of mine. We're working now to expand it to other regulators around the world. It's also, it's a great sort of recruiting and retention tool, to be honest, right? It's a great thing for staff to have available to them. So we're really excited about that. But then we have supervisory colleges around our global entities where all the international regulators will come together and just spend time in the same room with one another talking through supervisory issues. We recently convened a roundtable with about a dozen international regulators on stablecoin because there's an interesting issue sort of developing where every jurisdiction wants to require one-to-one reserving in their institutions, right? We require one-to-one reserving in FDIC insured or otherwise insured institutions. If every other jurisdiction says, no, you have to keep your reserves, right, in a French bank, in a Brazilian bank, right, that quickly becomes very capital inefficient. So how should we as regulators think about making sure we have enough comfort that we have the reserves we want to protect our consumers while making it as capital efficient as possible for stablecoin issuers, right? There's lots of emerging issues that I think regulators are really taking the opportunity to get together early on to problem solve, and I think it's incredible to be a part of that.
Yeah, you have just as many challenges as we do. So for all of the financial services entity representatives here, given how complex the world has gotten and given the myriad regulatory agencies we have to face off against, mm-hmm. do you have any advice to how we can do better and what we should be doing more of?
Yeah, it's interesting. I sort of remember being on the private sector side before I'd ever been in government and sort of feeling like, God, these people in government, like they just don't understand. They don't know how complex this is. They don't know how this works, right? And it's always easy to think that no matter what your circumstances are, that people that you're facing off against or people that have different experiences than you, right, just don't understand. And I remember then coming into government for the first time and going, whoa, this is way more complex, frankly, than the private sector. You're just dealing with a whole different set of stakeholders and a broader set of stakeholders. Frankly, it's one of the things I love most about public service is your ability to make a huge impact, but the complexity of the problems that you're dealing with. But again, I always say to folks, I know it is tempting and a lot of folks sort of have muscle memory about facing off against their regulator or having an antagonistic relationship with their regulator. But more often than not, I find that our objectives are in fact aligned. right? Even when we bring enforcement actions, right? It's not often that we have a company that goes like, we did nothing wrong. Like, why are you bothering me? Right? It's most of the time people know when they've violated the law, and the enforcement is never a pleasant experience, right? But we all know we're both looking to remediate, make this right for consumers and for the system. And so again, I always encourage people, have an open dialogue. The more you're engaged with your regulator outside of a specific regulatory issue, right? Outside of filing that you need approved, outside of an enforcement action that you're negotiating, the more that relationship exists and there's that credibility there, the regulator has line of sight into your business plans, especially if you're incorporating innovative technologies, the better that relationship is going to be. And it doesn't mean that there will always be agreement or that it will always be fun and easy. But I do think it just makes for better outcomes all around. And that's important to keep in mind.
Yeah, I totally agree that for the supervised entities and the regulators, our goals are aligned. Yeah. We didn't go into the compliance field to violate laws. We went to the compliance field to help the employers that we work for stay within the bounds. And we all know why that's valuable. Yeah. And so it's good to have guardrails, and DFS is a major part of that.
Well, and I would say too, I mean, for me, and I think for the teams, we've built such a diverse team. It's been so important to have people with a variety of perspectives, right? People who have spent time in the private sector, people who have spent time in other government agencies. So for those who can afford it, I always encourage people, right? If you have the opportunity to come into public service, I think it's such a wonderful thing for your career, for your own professional growth, to spend some time in service. I think it makes you more effective, frankly, if and when you go back to the private sector. Similarly, I think having, for myself, spent time in the private sector, it makes me a more effective regulator, because I understand the demands that some of the companies face. It also makes me better at calling BS when I hear it. But I think that diversity of experience, again, just makes for better outcomes all around.
Let us know how many resumes you get out of that.
Yeah, exactly.
Okay, final question, because we're up on time. 5 years from now, what is your vision of a perfect banking or financial services world? Where are we? What was your role in getting us there?
Well, one of the things when I came in, we changed the mission of DFS, because when DFS was created, it was sort of the wake of the great financial crisis. And so the mission was very crisis-oriented. We revised the mission statement to talk about our role in creating an innovative, transparent, equitable financial system. And so, my hope is that there is a point in the future where we have a financial system that is all those things, that serves people equally or equitably, transparently, right? And I always say, especially when I get to talk to our interns at DFS, was one of my favorite things to do. I came into financial services because it's a layer of the economy without which nothing else operates well, right? You can't be in agriculture or transportation or hospitality without banking and insurance and capital markets, right? Everything comes back to a well-functioning financial system. So if that's working well, then everything else at least has a better opportunity to work well. And that's, I think, I'm obviously kind of a financial services nerd, but that's a really special and important thing. So.
Thank you. Well, you've really enlightened us in the very short time that we've spent with you. And at the close of this meeting, I can now disclose that I work for an entity that is supervised by the DFS. So I have intimate knowledge.
Talk to her later for the war stories, I guess.
No, I wanted to add this perspective. I've been in this industry for 30 years, and I've faced off with lots of regulators, state, federal, and across the globe, the FCA, the Taiwanese regulators, and others. And I really appreciate DFS's direct approach to supervision. The superintendent mentioned Part 500, which regulates cybersecurity, sets some thresholds for what we must meet to protect consumers and the banking industry. But there's another regulation called Part 504, and that's the first one ever by any regulator that sets standards for how you manage the models you use for compliance functions. And these regulations are clear, but not too prescriptive. And from a supervised entity's point of view, it really makes our job easier because it is not an amorphous, ambiguous principle that you have to comply with and then find out during an exam that you haven't met with expectations. There are pretty clear rules of what is good. And when you can see what the regulator determines is good, you have a goal, not a moving target, to strive for. And that's a good way to partner with the regulator. So on a personal basis, I would like to thank you for DFS's approach to regulation.
Thank you.
Any parting words? No?
No, thank you all. It's good to be with you this morning. Stay dry. Have a great conference.